In early 2025, the United States, under President Donald Trump, made a bold move by imposing a 10% tariff on all Chinese imports. The administration justified this decision by pointing to trade imbalances and the increasing flow of fentanyl into the country. However, China was quick to retaliate, announcing its own tariffs on select American goods. The response included a 15% tax on U.S. coal and liquefied natural gas, along with a 10% duty on crude oil, agricultural machinery, and certain vehicles. This back and forth signaled a new escalation in trade tensions between the world's two largest economies. As these tariffs began taking effect, economic analysts quickly raised concerns about the possible fallout. If the trade dispute drags on, it could lead to higher prices for American consumers and a slowdown in U.S. economic growth. Some experts believe this could force the Federal Reserve to step in by adjusting monetary policy, which would, in turn, affect the value of the U.S. dollar. But China isn't the only focus of Trump's hardline approach. His administration has also set its sights on BRICS nations: Brazil, Russia, India, China, and South Africa. In a striking warning, Trump made it clear that if these countries try to move away from using the U.S. dollar in international trade, the United States will respond with a 100% tariff on their goods. Taking to Truth Social, he wrote, "The days of watching BRICS move away from the dollar while we do nothing are over." Faced with these escalating threats, BRICS nations have been quietly working on a strategy to protect themselves. Their chosen defense: gold. Over the past few years, BRICS countries have amassed more than 20% of the world's total gold reserves, with China and Russia holding nearly 74% of that total. China, in particular, has made a significant move in this direction. In January 2025, the People's Bank of China, PBOC, increased its gold reserves for the third consecutive month, adding nearly 5 metric tons to its stockpile. This brought China's total gold holdings to 2,285 metric tons, which now accounts for 5.5% of its foreign exchange reserves. Interestingly, the PBOC had paused its gold purchases for 6 months before suddenly resuming in November 2024, a shift that coincided with rising global tensions. China isn't alone in this approach. Around the world, central banks have been loading up on gold at record levels. In 2024 alone, they collectively added 1,045 metric tons to their reserves, marking the third straight year in which net purchases surpassed 1,000 metric tons. The motivation behind this surge is clear: global uncertainty. With economic instability and political conflicts on the rise, central banks see gold as a safe haven asset, and the result has been a dramatic price surge. Over the past year, gold has jumped from $2,500 to nearly $2,900 per ounce. And analysts believe China's aggressive gold purchases have played a major role in this spike. Adding to the intrigue, some experts believe that China's timing is not a coincidence. According to economist David Q from Bloomberg, the PBOC tends to resume gold buying right after major geopolitical shifts, suggesting that these purchases may be driven as much by politics as by economic strategy. For over a decade, China has been quietly working to reduce its dependence on the US dollar, despite repeated warnings from former President Donald Trump. Instead of relying heavily on American debt, Beijing has been steadily selling off its holdings in US Treasury securities, shifting its reserves toward other assets. Back in November 2013, China held a staggering $1.316 trillion in U.S. debt, making it one of the largest foreign holders of U.S. Treasury bonds. But fast forward to November 2024, and that number had dropped significantly to around $768.6 billion, a clear sign that China is moving away from the dollar. The trend has only picked up speed. Just between September and October 2024, China's Treasury holdings fell from $772 billion to $760.1 billion, indicating a continued push to diversify its reserves. Instead of putting its money into U.S. debt, China has been funneling funds into alternative assets. Gold and euro-denominated securities have become key parts of Beijing's new strategy. The reason behind this shift is simple. China doesn't want to be vulnerable to U.S. financial policies. With high inflation in the US and Washington increasingly using economic sanctions as a weapon in geopolitical conflicts, China sees a growing risk in keeping too many of its reserves tied to the dollar. Trump has repeatedly warned that this move away from the dollar could shake up global markets and hurt trade relations. But China isn't backing down. Instead, it's doubling down on efforts to strengthen the yuan's role in global trade. Over the past few years, Beijing has struck deals with multiple countries to settle trade in yuan instead of dollars. This includes major oil producers like Saudi Arabia and Russia, allowing them to conduct energy transactions in yuan rather than the traditional petrodollar system. By doing this, China isn't just protecting itself from US financial pressure. It's also challenging America's economic dominance. As more countries begin to use the yuan for trade, the demand for dollars in global markets could start to shrink. If this trend continues, it could have serious consequences for US economic stability and global financial order. One of the biggest factors in this transition is gold. China's central bank has been on a massive gold buying spree, stocking up on the precious metal as a hedge against dollar volatility. But it's not just China. Central banks around the world have been following suit. In 2024 alone, global central banks purchased 1,045 metric tons of gold, marking the third straight year that net purchases exceeded 1,000 metric tons. This flood of demand has sent gold prices soaring. A year ago, gold was trading at $2,500 per ounce. By early February 2025, it had surged to nearly $2,900. Many analysts point to growing geopolitical tensions and economic uncertainty as key drivers behind this price jump. The effects of China's actions are rippling across the US economy. By pulling its money out of US Treasury bonds and increasing its gold reserves, China is accelerating a process known as de-dollarization. If more countries follow China's lead, the US could eventually face higher borrowing costs and reduced economic flexibility. The US has long enjoyed the benefits of having the world's dominant reserve currency, giving it the ability to borrow money at lower interest rates and run large trade deficits. But a steady shift away from the dollar could change that. Even beyond China, other countries are making similar moves. Brazil's central bank, for example, has been steadily increasing its gold reserves as part of a broader plan to strengthen its financial stability and reduce reliance on the dollar. This suggests that the trend is not just a China versus US issue, but rather a global shift in how economies store value and protect themselves from financial uncertainty. Over the past few years, a quiet but powerful shift has been happening in global finance. Countries around the world, especially those in the BRICS alliance, have been steadily increasing their gold reserves, signaling a move away from traditional reliance on the US dollar. Brazil, for example, made a significant jump in 2023 by purchasing 100 metric tons of gold, up from its previous average of 80 metric tons per year between 2018 and 2022. This move wasn't just about adding to its stockpile. It was a strategic decision to protect its economy from currency fluctuations and external financial pressures. Brazil has historically been tied to the US dollar, but with growing global uncertainties, it has been looking for ways to diversify its financial safety net. Meanwhile, Indonesia, which recently joined the BRICS alliance, has taken a similar approach. In 2024, Bank Indonesia acquired 80 metric tons of gold, a sharp rise from the 50 metric tons it was buying annually in previous years. The increase, a staggering 60% jump, was fueled by its desire to strengthen economic stability and align with the BRICS bloc's broader goals. But among the BRICS nations, Russia has been the most aggressive buyer. In 2023, the Central Bank of Russia purchased an incredible 300 metric tons of gold, effectively doubling its annual acquisition rate from previous years. Between 2018 and 2022, Russia was buying around 150 metric tons per year. But escalating Western sanctions and financial restrictions pushed Moscow to drastically increase its reserves. With its access to traditional financial systems shrinking, Russia turned to gold as a way to preserve wealth, stabilize the ruble, and reduce reliance on the US dollar. Unlike currencies and foreign assets that can be frozen or blocked, gold remains a universally accepted store of value that cannot be easily controlled by foreign powers. India has also been steadily growing its gold reserves. In 2023, the Reserve Bank of India boosted its holdings by 200 metric tons, up from the 150 metric tons it was adding annually over the previous 5 years. While gold has always been an important part of Indian culture, symbolizing wealth and prosperity, the government's recent purchases show a shift toward using gold as a strategic financial asset rather than just a traditional investment. China, however, remains one of the world's most aggressive gold buyers. In 2023, the People's Bank of China expanded its reserves by approximately 250 metric tons, an increase from its annual average of 200 metric tons between 2018 and 2022. This is part of China's long-term strategy to diversify its foreign exchange reserves and reduce its exposure to the US dollar. The country has been working to internationalize the yuan and create alternative financial systems within the BRICS framework, further decreasing its reliance on Western financial institutions. Even South Africa, one of the world's leading gold producers, has been consistent in adding to its reserves. In 2023, the South African Reserve Bank purchased 50 metric tons of gold, a slight increase from its previous yearly average of 45 metric tons. While its acquisitions have remained steady, local mining challenges and economic conditions have played a role in shaping its purchasing decisions. The rise in global gold buying is not just a coincidence, it's part of a larger pattern. For decades, the US dollar has been the dominant global currency, a position cemented by historical agreements and economic strength. The Bretton Woods Agreement in 1944 made the dollar the backbone of the global financial system by tying major currencies to it, with gold backing its value. Even after this system was dismantled in the early 1970s, the dollar remained the world's reserve currency, supported by the sheer size and stability of the US economy. This dominance has given the US some unique financial advantages. The ability to borrow money at lower interest rates, run trade deficits without immediate consequences, and exercise financial influence over other countries are just a few of the benefits. French economist Valéry Giscard d'Estaing famously referred to this as an exorbitant privilege, highlighting the power the US holds simply by controlling the world's primary currency. In the years following the September 11, 2001 attacks, the United States began using its financial power as a tool of national security, leveraging the US dollar's global dominance to impose economic sanctions and influence international affairs. This tactic, often described as the weaponization of the dollar, allowed Washington to pressure nations by restricting their access to the world's most widely used currency. One of the most striking examples of this approach came under the Trump administration, which aggressively used tariffs and trade restrictions as part of its strategy against China. The goal was to increase the cost of Chinese exports, making American products more competitive and forcing Beijing to bend to Washington's trade demands. But China had a different plan. Instead of bowing to pressure, Beijing adapted by diversifying its financial reserves and reducing its dependence on US Treasury bonds. This shift gave China more flexibility in economic conflicts, making it less vulnerable to the dollar's influence. At the same time, China was strengthening its international partnerships, particularly with countries looking for alternatives to the Western-dominated financial system. Through initiatives like the Belt and Road Initiative, BRI, China built deeper economic ties with nations across Asia, Africa, and Latin America, offering an alternative to the US-led economic order. A crucial part of this strategy involved promoting the yuan as a global currency. By establishing currency swap agreements and encouraging trade settlements in yuan, China took concrete steps toward reshaping global finance in its favor. Meanwhile, other countries facing US sanctions, such as Russia, followed a similar path. After being cut off from much of the Western financial system, Russia ramped up its gold reserves and moved toward trading in non-dollar currencies. These moves signaled a growing shift among US rivals away from dollar-based trade, accelerating a trend known as de-dollarization. One of the most significant aspects of China's strategy has been its aggressive accumulation of gold. The People's Bank of China has been steadily increasing its gold reserves, a move that became even more pronounced in recent years. By April 2023, China's gold reserves had grown for the sixth consecutive month, reaching over 2,076 tons. But the buying spree didn't stop there. By the end of 2024, China's official gold holdings had expanded to nearly 2,264 tons, positioning it as one of the world's largest holders of the precious metal. This gold buildup isn't just about having more shiny bars in a vault. It's a calculated strategy to reduce China's dependence on the US dollar and protect itself from potential financial threats. Traditionally, about 60% of China's foreign reserves were held in US dollars, making it highly exposed to shifts in the dollar's value and vulnerable to American economic pressure. By shifting a larger portion of its reserves into gold, China is insulating itself from currency fluctuations and safeguarding its economy against external shocks. Gold serves multiple purposes in China's economic playbook. First, it acts as a hedge against inflation. As the value of paper currencies fluctuates, gold tends to hold its worth, making it a reliable store of value. Second, it provides a layer of protection against economic sanctions. Unlike bank reserves, which can be frozen or restricted, gold is a physical asset that can't be easily controlled by foreign governments. This makes it an ideal tool for countries looking to maintain financial independence in an increasingly uncertain global landscape. While China's focus on gold may seem like a modern strategy, it is deeply rooted in both cultural and economic traditions. Historically, gold has symbolized wealth, status, and prosperity in China, with a long-standing role in jewelry, gifts, and financial security. But in recent decades, gold has evolved into something much more than a cultural artifact. It has become a core component of China's economic security strategy. Between 2018 and 2023, China's annual gold purchases skyrocketed, climbing from 250 metric tons per year to an estimated 550 metric tons by 2023. This surge wasn't just about taking advantage of favorable gold prices. It was a direct response to growing geopolitical tensions, especially with the United States. By strategically increasing its gold holdings, China has positioned itself to weather financial storms and strengthen its economic resilience against external pressures. By moving away from the US dollar and embracing trade in gold and the yuan, China created a financial buffer against American economic pressure. Unlike dollar-based assets, which can be frozen or restricted by Washington, gold remains independent, making it significantly harder for the Trump administration to use financial sanctions as a tool against Beijing. At the height of Trump's trade war, the US attempted to pressure China by raising tariffs on Chinese goods, making them more expensive for American consumers and reducing Beijing's profits from exports. The idea was simple: make China economically vulnerable so that it would have to comply with US trade demands. However, China quickly adapted by diversifying its financial reserves, promoting the yuan in global trade, and expanding its gold holdings, making it less exposed to fluctuations in the dollar-based global economy. Instead of being forced into economic submission, China found ways to counteract US tariffs. It strengthened trade agreements with other nations, created alternative payment systems, and expanded its partnerships beyond the Western financial system. By reducing its holdings in US Treasury bonds and increasing its reliance on gold and non-dollar transactions, Beijing gained greater control over its economy and increased its financial independence from Washington. This shift wasn't just about protecting China. It was part of a larger global strategy. Many countries, especially those frustrated with US financial dominance, found China's approach appealing. The Belt and Road Initiative, BRI, played a major role in this transformation, offering nations a chance to engage in trade and investment deals without heavy reliance on the dollar. Through gold-backed agreements and yuan-based settlements, China provided an alternative financial system that gave its partners a way to bypass US financial influence. Meanwhile, the Trump administration attempted to push back against China's growing economic influence by discouraging allies from joining Chinese-led initiatives and tightening sanctions on companies like Huawei. But China's gold-backed economic strategy gave countries an option to sidestep US financial restrictions, making it harder for Washington to isolate Beijing economically. At the same time, the US expanded its practice of using financial networks like SWIFT as a tool to restrict China's access to global banking systems. This tactic was meant to slow China's technological rise, especially in industries like semiconductor manufacturing and telecommunications. But by accumulating gold and reducing its dependence on Western-controlled financial structures, China made it increasingly difficult for the US to use dollar-based leverage against it. This massive shift in global finance also had a huge impact on gold markets. China's relentless gold-buying spree didn't just secure its own economy, it also reshaped global markets in several ways. The constant demand for gold pushed prices higher, especially during economic uncertainty, influencing investment strategies and financial markets worldwide. Investors saw China's actions as a signal that gold was becoming even more valuable, leading to higher global demand and a bullish market for the precious metal. With China buying up huge amounts of gold, the market became more liquid, making it easier for other countries and investors to trade and invest in gold-backed assets. This increased liquidity also stabilized prices by reducing wild price swings, though sudden surges in demand sometimes led to short-term price spikes and speculative trading. Beyond gold prices, China's growing stockpile had wider financial consequences. By increasing its reliance on gold while moving away from dollar-based reserves, China helped accelerate a global shift toward currency diversification. The yuan became more attractive for trade settlements, giving the world an alternative to the dollar and contributing to the emergence of a multipolar currency system. As China continued buying gold, its actions also influenced global mining operations. Seeing this surge in demand, gold-producing nations ramped up mining efforts, adjusting supply chains and refining strategies to keep up with the changing financial landscape. As China continues to stockpile gold, it faces a growing challenge: how to keep up with demand without harming the environment. Mining gold isn't just about digging up precious metals. It requires massive amounts of energy, water, and land, often leading to deforestation, water pollution, and long-term ecological damage. With global pressure mounting for sustainable practices, China is now looking at ways to balance its gold accumulation strategy with environmental responsibility. In the coming years, China's gold-buying spree isn't expected to slow down. In fact, experts predict that by 2025, annual gold purchases could surpass 600 metric tons, making China one of the most aggressive buyers in the world. The Chinese government has already set long-term goals for increasing its gold reserves, using them as a safeguard against financial instability and a hedge against global economic uncertainty. To manage this growing stockpile efficiently, the People's Bank of China may begin adopting more flexible policies, adjusting its gold holdings based on economic conditions like inflation, currency fluctuations, and global trade shifts. Instead of sticking to rigid accumulation targets, China could shift toward a dynamic reserve management system, allowing it to buy or sell gold strategically in response to changing financial landscapes. One key aspect of this strategy is transparency. Historically, China has been secretive about its gold reserves, revealing only partial data about its holdings. But as the country takes on a larger role in global finance, greater transparency could help build trust with international markets. If China starts disclosing more details about its gold acquisitions, it could reduce market volatility and make the global gold trade more predictable. Beyond policy adjustments, technological advancements are set to reshape the way China acquires and manages gold. New mining techniques could improve efficiency, reduce waste, and lower environmental damage. Innovations in urban mining, a process that extracts gold from discarded electronics and industrial waste, may also play a crucial role in ensuring a steady gold supply without expanding traditional mining operations. Additionally, blockchain technology is emerging as a game changer for the gold market. By using blockchain to track gold transactions, China could enhance security, improve transparency, and streamline gold trading on a global scale. This digital approach could make it easier to verify gold authenticity, reducing fraud and increasing investor confidence. At the same time, global economic and political trends will continue to shape China's gold strategy. Factors like shifts in trade policies, international conflicts, changes in global growth rates, and financial regulations could influence how China approaches gold accumulation. If geopolitical tensions rise or inflation spikes, China may double down on its gold purchases as a safe haven. On the other hand, if economic conditions stabilize, the country could slow its buying pace while focusing on maintaining strong reserve levels. Sustainability is also becoming a critical part of the conversation. As environmental concerns grow, stricter regulations on gold mining are being introduced worldwide. Many companies are now expected to follow eco-friendly practices, reducing carbon emissions and minimizing the environmental impact of extraction. China, as a leading player in the gold market, will likely face greater pressure to adopt greener mining methods and ensure that its gold supply chain aligns with global sustainability standards. If you found this video interesting, be sure to hit that like button and don't forget to subscribe.